Today you'll discover how to think and how to trade like market makers and banks. And we'll cover one of their main strategies to control the flow of orders in the market. Probably the most important aspect of trading like a bank is to focus on liquidity. Liquidity is the lifeblood of the markets, and it's a concept that market makers and banks understand all too well. These institutions are like the puppet masters of the trading world, and they know how to pull the strings of liquidity to their advantage. You see, banks and market makers have a unique position in the market. They act as intermediaries between buyers and sellers, facilitating trades and providing liquidity. But they don't do this out of the goodness of their hearts. No, they're in it to make a profit. Banks and market makers have the advantage of being able to see the order flow, the stream of buy and sell orders coming into the market. By analyzing this flow, they can evaluate the market sentiment and position themselves accordingly. One of their main strategies is to influence prices and create temporary imbalances in supply and demand. Here's how they do this. Let's say the market is in a downtrend. The price has been falling, and everyone is looking to sell. Now at this point, if you're a bank sitting on a massive pile of orders that you need to sell, this might seem like a tough situation. After all, who's going to buy your positions when the trend is so clearly pointing south? Well, market makers have a sneaky little trick up their sleeves. They're not just going to sit back and watch their assets depreciate in value. No. They're going to create a trap that will lure unsuspecting traders into buying their positions, all while maintaining the overall downtrend. Let's say the market makers want to sell 10 million shares before the price reaches a certain lower level. They know that if they just start dumping their shares onto the market, it's going to cause a panic and drive the price down even further. So they need to be smart about this. They need to create a situation where people are actually willing to buy, even in the face of a downtrend. Thus, the market makers will engineer a period of relative stability in the price. They'll start by slowly buying up shares, creating a support, a demand area, that prevents the price from falling further. This buying pressure will be just enough to counteract the selling pressure from other market participants, resulting in a sideways movement in the price. Now here's where the psychology comes in. As the price starts to consolidate, some traders will begin to think that maybe the downtrend is losing steam. They'll see the sideways movement and start to wonder if the sellers are running out of ammunition. This is exactly what the market makers want. They're planting the seed of doubt in the minds of other traders, making them question their bearish bias. As the consolidation continues, more and more traders will start to feel like they're missing out on a potential reversal. They'll see the price holding steady and think that it might be a good time to start buying. It's a classic case of FOMO, and the market makers are counting on it. But the market makers aren't just going to sit back and hope that traders start buying on their own. No, they're going to give them a little nudge, and that nudge comes in the form of a false breakout to the upside. The market makers will strategically buy, pushing the price just above the consolidation range. This sudden burst of buying pressure will be like a siren song to other traders, luring them in with the promise of a trend reversal. As the price breaks out to the upside, many traders will interpret this as a signal that the downtrend is over. They'll start jumping in, buying in anticipation of a major rally. It's a classic bull trap, and the market makers are ready to capitalize on it. They'll start unloading their shares into this newfound buying pressure, dumping their orders onto the market without causing the price to crash. By creating this false breakout, the market makers have manufactured liquidity out of thin air. They've tricked other traders into buying their positions, all while maintaining the illusion that the trend is reversing. It's a brilliant play, and it's one that they'll use time and time again to manipulate the market to their advantage. And once the banks and market makers have started to sell their shares, they'll pull the rug out from under the buyers. They'll start selling aggressively, driving the price back down, and trapping all those traders who bought into the false breakout. It's a classic pump and dump scheme, and it's one that can leave naive traders holding the bag, while the market makers laugh all the way to the bank. As the price starts to fall back into the downtrend, many of the traders who bought during the false breakout will start to panic. They'll realize that they've been duped and will start selling off their shares in a desperate attempt to cut their losses. This selling pressure will only accelerate the downtrend, pushing the price lower and lower. And that is how the market makers create liquidity in a downtrend. They engineer a consolidation, lure in buyers with a false breakout, and then sell into that buying pressure before resuming the downtrend. It's a devious little trick, but it's one that works time and time again. You've probably been a victim of it many times before. So what can you, as a retail trader, learn from this? First and foremost, always be wary of consolidations during trends. If the price starts to move sideways after a prolonged move, don't assume that the trend is reversing. It could just be a trap set by the market makers to lure in unsuspecting traders. Second, look for upside breakouts in a downtrend and downside breakouts in an uptrend, especially if they occur after a period of consolidation. These breakouts are often false signals designed to trick traders into buying or selling before the real trend resumes. This strategy of creating a liquidity is really a masterful play that relies on psychology and market manipulation. In this chart, the market has been in a strong uptrend for the past few months. The buyers are in full control, and the overall sentiment is positive. However, you know that banks and market makers have a different plan in mind. They want to accumulate at lower prices before the next leg up. They always look for opportunities to create liquidity runs, and sometimes you won't see a consolidation, like in the previous example. They'll start by gradually selling, pushing the price down, and creating a small pullback below a previous minor or even major swing low. Other times, market makers will use this initial selling pressure to set the stage for a larger liquidity run. They'll engineer a period of consolidation where the price starts to move sideways. At this point, you need to be on the lookout for false sell signals. As the consolidation continues, market makers will strategically push the price below the lower boundary of the range. This downside breakout will trigger stop-loss orders and encourage traders to sell, thinking that the uptrend is over. Your job is to simply follow the market maker's grand plan. You know they'll use this selling pressure to accumulate at lower prices, tricking traders into giving up their positions. Once they've accumulated enough, they'll start buying aggressively, driving the price back up and triggering a series of new buy signals. That's your cue to join the uptrend. Here's another example. Observe these consolidations and downward pullbacks in the uptrend. All of these were followed by liquidity runs, engineered by banks to shake out weak hands and accumulate at lower prices. Always look for these false breakouts to the downside, especially if they occur after a period of consolidation. When you spot a potential liquidity run, you could move to a lower time frame to pinpoint your buy entry. Pay attention to upside breakouts, new higher highs, or breakouts above minor resistance levels. These signals are your lower time frame confirmation that the uptrend is still intact and that market makers are back to buying positions. Just as banks use liquidity runs to accumulate in an uptrend, they also employ tactics to distribute in a downtrend. Here we have this market that has been trending lower for several weeks. In this case, you look for consolidations and upward pullbacks within the overall downtrend. During consolidation phase, you need to be patient and wait for the market makers to strategically push the price above the upper boundary of the range. You know that these upside breakouts triggered new buy orders and encouraged traders to go long. Banks use this buying pressure to distribute at higher prices, effectively tricking traders into taking on long positions just before the next leg down. When you spot a potential liquidity run in a downtrend, consider moving to a lower time frame to pinpoint your sell entry. Once the market makers have distributed enough, you know they'll start selling aggressively, driving the price back down and triggering a series of sell signals. So you pay attention to key sell signals, such as new lower swing lows and breaks below minor support levels. These signals can confirm that the downtrend is still intact and that market makers are back to selling activities. This whole process is a masterful manipulation of market psychology, and it's a strategy that they'll use repeatedly. As a retail trader, your job is to stay vigilant, recognize these tactics, and look for key signals that confirm the previous trend. You won't catch all the liquidity runs, and you won't be able to avoid all these traps. But with knowledge, discipline, and a decent risk management plan, you will still find plenty of opportunities to profit on all timeframes. And if you want to learn other smart money tactics, you need to watch one of these videos next.